On a step further, sorry Andy, flip back one. So Andy mentioned earlier about customer experience. So let's just quickly think about that. At a high level, customer experience in dealership, it's probably not great, even if they were conscious that their credit file had some challenges on there and they were sort of half hoping they might be accepted. It's still not a great experience, but it's beyond the experience of just that purchase for that consumer. That hard search on their credit file, that decline, potentially has an impact on their credit score ultimately, but also their future borrowing potential. A future lender might decide not to lend to that consumer because of that decline, or they might offer a less favourable rate as a result of that decline on their credit file. So you can imagine what multiple hard searches against a consumer can have real impact on them. But again, just kind of flipping that into why has this customer walked away? A customer might be, at the same time as thinking of a new car, they might be looking for their first mortgage and all the heightened awareness of what's going on with the credit file. Do they think, actually, I'm not sure what's going to happen with that credit application and maybe I should just wait, do nothing right now, and they walk away. And they might not tell the salespeople that, but it looks like you've invested huge effort and time and the customer's ultimately walked away. And quite frankly, I think customers expect a lot more from the finance process now. They expect more clarity and certainty around it. If you want to take a credit card or a loan, you can go to a lender direct very often, or a price comparison site. You provide them with some of your personal information, and they'll come back and say, you are 100% likely to be accepted, pre-approved for this loan, or they'll tell you otherwise, and they'll often tell you what the rate is as well. So you've got that certainty and clarity over the decision. And I guess the question is, why should that be any different in the auto industry? Why should my car purchase look any different to that? Thanks. So the question to I guess retailers and dealers and lenders alike is, why wouldn't you want to know more information to help you build the deal sooner? So you already do the sort of research for the consumer, the fact finding, what's their budget, what kind of things are they looking to do with a car, what colour do they want, what spec do they want. Why not take that a little stage further and understand who is the right lender for this consumer? Is that lender ultimately going to accept this customer for this deal, and at what rate? And that enables a dealer to build a real certainty of offer to that consumer. Thanks, Andy.
So, talking about kind of the frictions and the challenges across retailers, dealers, lenders as well. Effectively, what available in the market and available as a solution is eligibility technology. So, what is eligibility? What does it mean? It's not a pre-approval. It's to highlight the eligibility. But effectively, it allows a retailer and allows a dealer and a lender to understand the consumer credit profile of that individual. So it provides you information on where they rank, where they rate. It supports a retailer and a dealer to quickly identify whether or not that consumer will be able to get credit approved before an application, before spending that time with an F&I manager or a business manager going through that process. So it gives more information sooner and earlier in the process, and that ultimately helps to streamline that process as well. So less time spent kind of worrying about will I, won't I, what kind of rate will I get approved, etc. Kind of really support streamline that process, and to kind of go back to the costs on the business, to the costs on a retailer, the time spent as well, not just the monetary value. But the time efficiencies as well. If you can identify, or if you can easily identify a customer, their chances of approval, their consumer profile, what rate they may get early in the process, it helps support from a cost perspective because it effectively streamlines that finance application. And then Matt touched upon it. It will help lenders as well improve their underwriting efficiencies. So, Matt talked about different variations of cost to a lender. And the lenders that we've been speaking to do range from £20 per credit application that is declined up to £150, and that all encompassing can be the cost to hit the bureau, the cost of that person sitting there going through the manual underwriting process, bums on seats, electricity. So it does, that £150 is quite an all encompassing cost, but it still weighs on the bottom line from any business. But what eligibility also does is support the implementation of a rate for risk model. So we're now seeing the lenders and the retailers that I speak to there was a WebEx not too long ago with Black Horse talking about what retailers are looking down to go down this path now, and it's starting to be more prominent. A lot of retailers and lenders are considering this approach moving forward now, so it's going to grow. So eligibility provides a good foundation to support that with a solution to drive a risk that is specific to that customer, drive a rate specific to that customer's risk as well. And Matt touched on it from a customer side. The person buying this car and funding this car is a customer. So improving the customer confidence, making it very clear, and providing that clarity up front before kind of taking them down this can be a long process, a daunting process from a consumer. Provides that can provide their eligibility to them up front and give them a very clear and concise path of what you're going to go down, and whether you'll be approved, what kind of rate you'll get. Can only kind of support that kind of consumer experience as well. How does it work, and where does it work, I suppose, is a key question. A solution, or a solution that we've worked on with Experian, is available from a hybrid model. It doesn't have to be a kind of traditional customer coming in, kind of bricks and mortar. It does provide the solutions, and the technology do provide the eligibility technology to do a hybrid. So it's a digital retailing customer that may start online, may come offline, or vice versa. Typically 90 days is the typical buying cycle, and starts with the research up front from a consumer. So if they're dipping in and out of online, offline journeys, so it can support both. So effectively, how we've integrated and how we work with Experian is we provided the solution as to a retailer, to an OEM, and to a lender, and effectively we will reach out to Experian, take the consumer data, a very small subset of consumer data, send that over to Experian, and then we're able to provide that data back to us, and then we display that. And then that uses, so eligibility complete, but also provides that foundation from a rate for risk perspective as well. So how does it look, and what does it look like? So this is a live example of how it looks within our Codeweavers solution of Commerce Hub. Everyone else can hear that as well, right? It's not ringing in my ear, is it? No, okay. So effectively, what we wanted to kind of talk about here is like what it looks like. How does it feel? What's the taste from a retailer perspective? What do they see? So you see, we working with Experian, we provide two scores. There's a consumer score, which is an indication that consumer's credit profile of how likely they are to achieve to be approved for finance. That could be. It's not bespoke to automotive. It could be. It's a generalistic view. So, if that customer was to apply for a mortgage, this example is excellent. So, the grading on that really kind of aligns itself to this customer is excellent. So, they may be more aligned to being approved by a prime lender. If a customer starts to scale down, the consumer scores are. Qualitative scores, so it's not a numerical score. It can be turned into a numerical score, but with a qualitative score, kind of provides a little bit more insight, because one score to another score from another bureau, this doesn't always line up particularly well. This is very kind of clear and concise from a consumer journey. Allows a retailer to have that discussion and say, this is where you sit from a profile perspective. The second portion of eligibility in a solution is the lender score. You'll see on the right-hand side there's a percentage, and this is the likelihood of this consumer. So in a journey, I would provide some basic PII data, nothing more that's really required to capture a lead. first name, address, and just some kind of housing and employment status. And then we provide that through to Experian, and we get back a likelihood score from Experian when a lender works directly with Experian. So if a lender works and shares scorecard and credit policies with Experian, we can send that consumer through, and Experian will run that against that lender, and they will provide a likelihood score. So that likelihood score is so example here, 70%. So this consumer of this profile has a 7 in 10 chance, effectively, of being approved by this lender. You'll also see a rate in there as well on 2 different finance products, and this is really where we can start to support a rate for risk model, but also it works easily as well as in a fixed rate kind of campaign or a fixed rate APR as well, where we can match that in some of the technology that we have. So where we work with a retailer and we work with the lender in question, we're able to provide that rate, an evidential from a rate side, but also the likelihood score, and that's quite key. So we're saying that this customer has a 70% chance of being approved on this for finance through automotive, based on this lender. So typically it would say the lender name, but obviously we're being agnostic at this perspective. And that can differ by product as well. So all great, right? I'm telling you what we can do and how we do, and I want to make sure that we prove it, right? The proof's in the pudding. So we have been working with a lender directly who have shared portions of the scorecard with Experian, and we've been working with a retailer group as well. So just to set the scene, this lender has a approval rate on their used car business at around 60%. So that's purely approval, no finance penetration in terms of contract activation or anything like that. Purely 60%, and that was prior to turning on the eligibility technology and the solution that we offered them. From that, so let's say 100 customers, 60 are approved. From those 60 customers, 50% of those, so half of those customers, are typically approved in the current climate, based on this lender and this retailer. And they class that they're approving a lot of deals, but a lot of those deals aren't, well, over half those deals aren't actually being activated. So people are spending time submitting applications to this lender. The lender is spending time looking to underwrite this business, and it's going nowhere. So they're losing business, but they're spending time and energy and money to try and generate and activate this contract from an underwriting perspective. So we work with the lender, we work with the retailer, and obviously with Experian, and we turned on the eligibility. It's been running for a couple of months now. We're starting to expand out to other lenders and other retailers, but since we've had the eligibility solution turned on in the product that we provide this lender and this retailer, we've seen that the rate of approval from this lender so when a customer comes through the door and they are the retailer uses the eligibility solution that is attached to this lender, the approval rate, so out of 100 customers that have been sent through, 95 are approved. So see the change. So by taking less information from the customer, trying to kind of support the customer's needs and not taking them down that huge, long, drawn-out credit application process, we've seen an increment of 95% of credit approvals. And then moving on to kind of contract activation or finance penetration, from those 95 customers, let's say I have 100 customers, the lender has come back and said, out of those 95 customers, we funded 86% of those. So we saw a 46% increase on finance penetration based on their previous numbers. So less time taken to arrange this up front from a customer side and generate the eligibility score with the retailer. And if we look at the efficiency savings, if you look at a lender who's 150 costs £150 per decline, you can multiply that, and there's grand savings that are available there as well. Some lenders may pass this back to a retailer in VB or commission, etc. There's different methods out there, but there's fundamentally a bottom line saving from a lender side, but also the improvements from an efficiency and a retailer side as well.
So I'll pick the first couple of points up here. So I guess talking specifically about use cases, those stats really back up what we see in eligibility across other markets as well. You could probably argue that, yeah, we can understand why accept rates would increase, absolutely. You're doing a sort of pre-check. You can see why presenting the right customers in front of the right lenders, at the right rates, that would increase accept rates. I think the kind of second point is key. They converted more. And you can kind of question why are more of them converting? And I think it comes back, we mentioned the words certainty and clarity earlier. By giving both sales teams certainty and clarity of offer, they know exactly what they're presenting to the customer, and they know it's a real offer from a lender at that early stage. But certainly from a consumer point of view, you've taken away that uncertainty, you've given them the confidence to move forward, and we absolutely see that more customers take that next step and convert from that point.
Just to kind of carry on with some of the benefits that we found and the opportunities that can kind of come out of this as well, is that by using eligibility, if you look at it from a marketing perspective, whether digital marketing or traditional marketing, you can use the eligibility to present customers an offer around finance which is specific to their needs and their desire. So it can be used not just as kind of transactional, but from an aspirational marketing side as well. So without impacting having any negative impact on the credit score for the customer as well. So it makes it a little bit more kind of fast and convenient. If you can run someone through an eligibility solution, you can have a tailored marketing offer specific to that customer, knowing full well they've got a very, very good chance of being approved, which starts to pounds per digital marketing spend and cost. You can be a little bit more direct to providing the right message at the right time, the right offer. Fundamentally, from a lender perspective, can be more profitable because you're not spending time, knocking off deals that you were never going to approve. So improves from an efficiency side, helps increase the acceptance rate, and reduces risk by matching the right customer to the right product that they can afford as well. And supports from a regulation perspective as well. So we're trying to put the customer's best. I say we're trying to put, but as an industry, we're trying to put the customer's best interest at the forefront as well. By being clear and concise at the beginning of the process, it makes it a little bit more fluid and a little bit easier for them to take the steps through. Mentioned kind of earlier on as well. So we're seeing having a lot more conversations about how we as a technology company can support a retailer lender moving into a rate for risk model. We're talking about hybrid models. One lender wants to do who has multiple retailers. Some want to do a fixed rate, some want to do a rate for risk model. And how do they implement that? How can they manage that risk and supply that rate? So through using eligibility and some of the solutions that we have, we can provide that. But what it does also support is the evidential information as well. So if that customer ever came back further down the line and say, why did I get that rate? It's logged. The data's there to be provided as well. And you can take them through that process. This is how we used your information to generate that rate using the nominated lender and passing them through this type of solution. We can also align the consumer scores against a rate matrix. So, we've talked about a qualitative consumer score: excellent, fair, good, poor. They're quite generic, but they can be lined up to a specific rate. So, excellent can drive one rate, poor can drive another rate. But also, we can move it into a kind of quantitative method as well. So, where it does come back as a credit score as a number. So, 650 plus might be X rate. 550 plus might be X rate as well. So the technology and the support through the solution can power kind of different methods as well, depending on the lender and the retailer as well. And again, what we've also done to kind of support this, going through evidential is evident the information is when an application goes through and the customer is given the rate from an eligibility side. In some of our technology products, we provided that we'll fix this rate. So from a business manager side or an F&I side, they would be able to run the customer through. If they get back 6.9, they can't go, well, I'm going to try and put this at 7.9, right? So we'll be able to restrict that, but also kind of support a good sales process from an F&I perspective as well. I think we've covered what we wanted to try and cover today.
Absolutely.
I'm conscious of time. I've had the wave. So thank you very much for listening. I hope you found it useful. We are open to some questions or comments if you have any directly to Matt and I.
I think the microphone's coming.
Oh, it's coming, sorry. I was going to pass you this then, I don't know.
I feel a bit awkward. Yeah, so when the eligibility calculation is taking place and the customer's made the application, then from that point, how does it then... so if it's 70% likely that the customer may get accepted, is it then... Because I've experienced it myself where I've gone through an eligibility calculator and gone for the headline rate of 2.9, but then it might have come back at 4.9. So how do you deal with that?
Yeah, that's a good question. When we're talking about kind of, especially if we use the example from a digital side, right? So you know, we're seeing more digital dealers start now, and everyone's trying to kind of make that digital presence very clear. Some of the conversations that we are having, we're trying to look at is why don't we start that eligibility process at the beginning before you even look at a vehicle, before you even start dreaming of what rate I can afford. So we're talking to some retailers about having that at the start of their journey, and then rather than give that headline rate or representative APR, it's bespoke, right? The rate's bespoke to that consumer based on their risk, and the calculations can all be driven from that point continuously as well. And then the fact that you get the likelihood score back from Experian, you know, that can range from 0 to 90 to 100%. You know, if it's coming back, then I think that kind of would support that. But you know, that's complete utopia, right? That we'd love to kind of be able to support that. But you know, we've got to change the way we kind of transact as well. But I think it will support.
Yeah.
Yeah.
And that's how a lot of businesses use it. They'll have a headline rate, but they'll say to the consumer, this is the headline rate, but let's check what your rate's going to be. And straight away, you're collecting some data and you're able to provide them with something really, really kind of clear and certain.
I suppose you could start at 0%, couldn't you? And then it doesn't really matter what the headline rate is. It's the rate that you're going to get.
It's your rate.
Yeah.
So
Yeah.
all
It
the
becomes
other stuff's
transactional.
irrelevant then, isn't
Yeah.
it?
Yeah.
Because that's what we're all struggling with.
Yeah.
Yeah. Absolutely.
Do you rate or do you qualify a customer differently depending on the type of finance product that they're interested in, i.e. hire purchase, lease, PCP?
So essentially what we do, we act as almost an independent state for a lender. So we will host their decision rules and policies. We will match their bureau settings and their bureau within our environment. So essentially what the eligibility call is doing, it's calling in and saying, would this, and this can be multiple lenders as well, not just one lender. The request coming in, and we're running that customer through that lender's decisioning, hosted by us. So we pass back the result, and if that request is for a HP or PCP, we're running it by the rules that lender uses for those products. So yeah, specific to the product. Oh, 1 minute.
I was just wondering how real-time the data source is that's being run through Experian.
Yeah, so we sometimes tell a story about the price comparison sites that we actually have to slow the response down to them because if we send it too quickly, they don't think we've checked. But it is real time. We send a response back within a few seconds.
I just meant in terms of the customers' affordability, for example, like given the pandemic, you know, how people have lost their jobs and things like that. So I'm just wondering if it's a historical data source or if it's quite real time, like, yeah. Yeah, so the data source is the bureau that the lender uses. So the credit reference agency that the lender uses that we're referencing, Experian obviously being one of those. So it is as up to date as any data can be. Yeah. That's our time, apparently.
Thank you.
Thank you.